Okay, I think I've been given the go ahead to start. So today we have a very interesting topic. Uh, what is the right allocation for you in 2024? Now, I also did a very similar webinar in the last week where it was what is Milestones2Wealth doing versus somebody having a direct stock or a direct mutual fund sort of an investment. Right. So I have taken a couple of slides from that webinar also, just as an exercise because it was a very good exercise. Uh, so I've taken that part also, and I've added a couple of more slides. Uh, Something in relation to asset allocation. Right. So this is one of my favorite slides. Right. This is the best way for an investor to understand how do market cycles work. Now, when you look at the market, uh, from a very short term perspective of say 2 3 years, you will see a lot of waves up and down. Right. So when you see a lot of waves up and down, naturally you do get scared. Naturally, you do want to time the market. Right. But if you look at it from a longer term perspective, you will only see like a very stable sort of a chart. Now, what happens in the middle? Now, what happens in the middle is when there is fear, which means that everybody does not want to invest their money, does not want to save their money uh, in equity instruments. Right. On the flip side, what happens when the optimism starts coming in? Right, when the optimism starts coming in, that's when you see that the chart sort of goes up like this. That's where greed comes in. Now, why do we say fear and greed? We say greed because as the tide keeps changing, as the cycle keeps changing, uh, you will see investors, businessmen, everybody wanting more, right? They'll be willing to commit more for more, right? Now, you don't know whether, committing more might actually get you that more. That's where the risk part comes in. And that's where the greed comes in. That's where everybody, you see the languages starting to change in the newspaper, you see languages change in the news channels, even among your peer sets, with your friends, the language keeps changing. Everybody sort of gets into the market, right? The participation levels start going up very drastically. And this doesn't happen over a month, over 2 months, or over a year or 2 years. It takes time. It takes at least 5 6 years for an entire cycle to play out, for it to go from I don't want to invest to yeah, I only want to invest. Right. So you would see this sort of trend everywhere, where you would see a lot of optimism coming in. And today we are in that place where optimism is starting to come in. Optimism is here to stay. Today you're seeing, Nifty also at all-time high levels, right? And you are seeing every day somewhere in the newspaper, you do get to hear that your this particular institute is predicting that India will grow at 6%, 7%, 8%. And then you see that the optimism level in terms of foreign investors also for India is very high. So, like, you flip it. Now you look at fear. Now you look at fear in terms of the Chinese market, because now in terms of China, there is a lot of pessimism taking place. There is a lot of pessimism taking place, right? You are seeing every day in the news. You're also seeing on YouTube, wherever, on social media also, that the Chinese stock market is now somewhere around is 2007 lows. Right? There is deep pessimism, which means there is deep fear. Right? All foreign investors are pulling out money from China. So this is where there is deep fear, and then there is deep optimism. Right? There's your pessimism. There's your optimism. Right? So now you're seeing how market cycles really work, how people perceive the entire cycle to play out. Right? It's very simple. Right? So what do you do as an investor? Now, these are the investors' dilemma, which is basically things that you think of, things that you always it's always going at the back of your mind. Right? Is to save every month. Yes, you do look at your budgets to see, no, where can I cut off? What do I need to spend less? How do I actually go about and saving more? Right. Second, yeah, there are some months that are very abrupt, right? Some months are high, some months are low, and you want to make sure that you're consistently saving, right? You want to get into that habit of consistently saving money, right? Month on month, and make sure that every time you are able to save more, right? Now, let's say you go out and start investing. You want to avoid losses. You do not want to see any sort of reds that do come in, which is, I think, a little unreasonable. But yes, that expectation is always there. That I want to avoid losses. In any given scenario, I don't want to make that loss. I want my money to actually go over and start making money. I don't want to make a loss, right? And I want that money to grow, which is compound regularly, right? I don't want to lose money, but at the same time, I want to continuously keep making money, right? That's the expectation that's there, right? We're being honest here. Then, we do, no matter how much we say that no, we do not want to time the market. Yes, definitely there is a bit of timing that comes into place, right? But how much, that I will show you in the next slide as to how much timing should be a part of our entire decision making. Right. So you want to invest at the right time. You want to make sure that this is the time for me. At this point in time, I am sure that I'm going to avoid losses and I'm going to consistently make money. Right. The most important thing is this: investing at the right places. Now, most investors miss this out. Right? Because for most investors, there is only one asset in mind, that is equity. Right? No, nobody thinks of debt, nobody thinks of gold, nobody thinks of global, nobody wants to think of all the other aspects in terms of asset allocation. Right? Majority of investments that you want to invest in, you want to invest in equity because they offer you that sort of growth, and it's very reasonable. Yes, because they offer you that sort of growth, naturally you will be inclined to go there. But what about the times when uh, you know equity does not do well for you? What about the times when you got in at the wrong time? That is when this is when during the greed phase, right? Where you are going on more to the greed phase, where you are starting from a very optimism point of view, thinking that yes, I'm going to compound regularly. But what happens then you are not at the right place, right? So how do you avoid these dilemmas? How do you make sure that you are having you're getting invested at the right place, you are investing at the right time, you are able to compound regularly, right? Which means it's not just in one asset class. You have to go towards multiple asset classes. So how do you solve this dilemma? You have to only look at asset allocation. Now, the only reason of why investors do not look at asset allocation, one, I think that thinking that they are low returns is not a reason for you to miss out on asset allocation. Now, these are not asset allocation funds, but this only means having a lateral shift from one asset class to the other asset class when optimism in one asset class is very high, right? So, which means that market cycles for individual asset classes in each asset class is very different. Some asset class might be more on the optimism side, some might be on the pessimism side. So you have to go from optimism to pessimism. You have to make that lateral shift. And that's where asset allocation really comes into place. Right? Having a certain amount in some asset classes work, but it only works according to your risk profile, according to your goal. Right? This is how you're able to compound regularly. Right? This is how you're able to preserve your wealth. This is how you're able to grow. See, as your only goal should be that you want to preserve wealth creation. It should not be that I'm willing to take higher risk and I'm going to make higher returns. No, it only has to be in terms of growing wealth and preserving wealth. That's where you have to make such lateral shift, and that's why you need to think of asset allocation. Right? All of these dilemmas will just get solved by making sure that you just think of asset allocation. Right now, this is the deciding factor. Now, this is all public data. These are all data that I have taken from uh, uh, mutual fund presentations or product presentations. And this again is from one of the product presentations where they said that asset allocation is the most important decision when it comes to constructing a portfolio. So if you see 91% uh, is actually that deciding factor when it comes to portfolio returns. Right? That's why they think of, I want to make more money, but the only way I can do it is asset allocation. So you look at market timing. Market timing is very, very low, right? Market timing is extremely low. It's just for 1.8%. And this is a good study, right? It was a very good study that concluded that asset allocation is the most important decision, that explains this sort of returns in terms of your returns are different, somebody else's returns are different. Why is it that your returns, why is it that their returns are different? It's just about asset allocation. It has nothing to do with what they buy. It has nothing to do with when they buy, but it is more to do with how they are buying, asset allocation, right? uh, Now, what happens when nothing happens? Now, this is when I was telling you that if you're going to stick to only one asset class and you are a long-term investor, what really happens then, right? Indian equities from 97 till 2003 made 0% return, right? So, can you see a part where you don't make any money? 0% return. Again, international equity, because of the tech boom, a lot of investors did look at global investments. Not only I'm not talking about India specific, but globally, right? But had you invested in international equities, your returns would be 0% from 2000 to 2005. Again, right, this is another class. Then you have gold, which is another asset class. So from 2011 all the way till 2019, there was no return in gold, 0% return. Right? Don't make. Right? This actually means that yes, from time to time, optimism and pessimism keeps changing in asset classes, which means you have to be more on the pessimism side. You have to buy when others are fearful. You have to start saving more when others are fearful. You have to be greedy only when uh, others are fearful. Your part is only inverse. So if I take you back to that previous slide, your part is inverse. When everybody says sell, 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 it is buy, buy, buy. When everybody says buy, 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 it is sell, sell, sell. As simple as things can be, right? That's a very good outcome. It will lead into a very good outcome, right? Uh, Sorry, yeah. So 2008 till 2013 also in equities is 0% return. So what should an investor do then, right? Winners keep changing, right? How do you win in all markets? So if you look at multi-asset alone, right? This is just for example. This is not a recommendation at all. I've taken multi-asset because you will have all asset classes. So naturally you need to see how all these asset classes sort of go out and perform, right? Now if you look at 2016 till 2020, gold has done extremely well, right? Gold has come out on the top. Equity, not much, right? But look at from 2019 till 2023, your debt has been a laggard, right? Though 2 years of 2019, 2020 were good in terms of debt, but it didn't cover up for what happened in the next 3 years, right? So if you look at uh, uh, the winners, 2018 to 2023, there was one particular winner. But if you look at 2009 till 2014, you're seeing equity doing extremely well, right? In terms of pure returns, if you just compare it to other asset classes. So now, if you see something that has been consistent, because you want consistency, your multi-asset has always come up in the top two, right? More or less, there are barely couple of years in which it did not do well, right? So having a multi-asset sort of a framework, which is more asset allocation oriented, so having this sort of asset allocation framework, you're able to go through bad times and good times very, very easily, right? In the good times, you're being rewarded. In the bad times, you're being saved, right? That's what asset allocation does for you. It gives you a push when things are doing extremely well, and it protects you when things are doing extremely bad, right? Now, understanding why asset allocation works, right? Why does it work? These are all past data, but actually let's look at real time, right? This is what has happened, but let's look at how investors are really working on asset allocation. Now, you just look at the last 2 year returns of the market, right? So and this is all public data. So last 2 years, your small cap has done well in 2023, but in 2022, it did not do that great. Right? Gold has done somewhat at 12%. Again, 2023, 12%, which means your gold is compounding at high double digit rate, 12.5, 13% sort of return. Right. Again, if you look at large cap, there's no slowdown. International, a big jump, big jump. So I've showed you, the last 2 years data. So assuming that you started investing in 2020, right? Where would you go out and start parking your money? Where would you go and start saving your money? You can put your answers in the chat box. Is it gold? Is it small caps? Is it international, or is it credit risk? So where are you going to go and start saving your money? Assuming you started in 2020 and now you know what has happened in 22 and 23. So you can put your answers in the chat box. Okay, somebody said small caps. Then there was gold. Okay, so top two. A mix of all. So you will have gold, small caps, international, and credit risk. Okay. Oh, somebody said 20% gold, 30% small caps, 30% international, 20% credit risk. Okay, so all the four, all the top performing. Okay. Okay. So I think majority of you said that you would have, you know, somebody said none of the above. Okay. I would love to know what your real answer is then. You can also put that. There's no problem in that. You can put what you actually want to do also. So that's completely fine. But a majority of you have said that you would want to go more towards small cap, you would want to go more towards gold. Uh, a lot of you said that you want to do all the performing ones. Okay. Okay. You commented saying better to go with other non-performing areas. Okay. Very interesting. Okay. So now actually let's look at what's happening. So if you look at 2020, 2021, small caps did very well. But you look at from 2018. Now there's a reason of why I put from 2018, because in 2020 you are not going to see 22, 23, right? You are going to see 18 and 19, right? You're going to see the past year returns to make a future decision, right? That's what investors do, right? But that's not how asset allocation needs to be done, right? So 2020, 2021, your small cap did very well, but in 18 and 19, small cap and mid cap were the worst performers in the market, right? And because you are seeing year to year data, you are not able to take a proper decision when it comes to long term investing. So 18 to 23 is somewhere around 6 years. So in 6 years, 18 to 23, what would be your CAGR in small cap, or what would be your CAGR in gold? Now, for those of you who said gold, gold has been a consistent performer from 18 all the way till 23, right? You see how strong, gold performance has been, right? You look at how international also has sort of played out. And if you look at large caps have been quite stable. Right. But if you look at 18, 19, and 20, your debt actually did much more better. Right. Your debt also was doing a lot more better than small and mid caps. So if you start from 2020, you are going to see the past return. You're going to see 18 and 19. You're not going to see 22, 23. Right. This is how investors are thinking of saving. That you look at past returns to determine what your current asset allocation should be. And that is not how you actually look at asset allocation. This is not how you are able to compound regularly. Right? This is that area where you are not investing at the right time, nor are you investing at the right place. Right? Because You are seeing past data, and somebody commented saying, no, better to go with non-performing asset classes. Yes, though I would like to know that when you say non-performing asset classes, what do you really mean? Like, where you're taking a conscious call on valuations or you're taking a conscious call on quality, right? That is what I would also like to know. But if you start from 2020, because you know what's happening, you are not going to look at the you know past, right? But when you actually go and start investing money, we only look at the past, right? So we have this hindsight bias that comes into play, that hampers our decision when it comes to asset allocation. And we are foregoing future returns, which means we are not willing to compound regularly because we are not investing at the right places, we are not investing at the right time. Right, now there's one more. Now, does your answer change? Knowing these facts, does your answer change? Yes or no? Yeah, somebody said definitely yes. Yes, okay. Yes, okay. Everybody that commented saying I will go with the top performing now say that no, I would not go with the top performing. My answer would change. Now I'll give you one more opportunity. I'll give you one more chance. We'll go further back, and and then you can think of what you actually want to do. What you want to do. You take a longer term exposure. Now, this is where we started from. You can have a good look at this chart. 18, 19, 20, 21, 22, 23. We had small caps, 18, 19, not do extremely well. 2021 did extremely well. But if you see from the peak, right, from one peak to the other peak, that is 18, 19, 20, 21, right? Uh, your small cap returns from peak to peak CAGR were somewhere around low single digit of 3%. Right. So still, this is where you're missing out on compounding. Right? This is where the right time, right place comes into picture, because you're going to save more, you're going to save regularly, and you want to go in with thinking avoiding losses. So you're going to go to the best performer. Right. Now let's go back further. Assuming you started investing in 2018, where would you invest? Would you invest in gold, small caps, international credit risk? If you do want to invest, yeah, in other asset classes, something else, do put in your answer there also. Okay, there's a comment saying always mix asset. Yes, you should always mix. You should always have a good asset allocation mix, but that doesn't mean that you should always stick to one asset class or have more of one asset class, because like I said, optimism and pessimism keeps changing even in asset classes during the market cycle, right? So you have to take a conscious call, in choosing one particular asset class. Large caps have given decent return and consistent returns in the long term, so you will stick to large caps. Okay. What about everybody else? Okay, international. Okay. Okay, there's small cap and gold. But I thought that your answer is changing. Okay, you added small cap to that answer. Okay. Gold is just for liquidity and beating inflation. Okay. So your answer would not be gold, your answer would be something else. Okay. Okay, somebody commented debt funds and small cap. Okay, I don't think there's any further answer, but more or less now everybody's answer is sort of different. Right? you are telling about somebody said large cap, somebody said I'm still going to stick to everything. Somebody purely stuck to international now, and you have said no for gold, and somebody said debt and small cap. Right now, sorry. Now let's look at from 2014. Debt has been the best performer, right? So if you look at 2018, yours when you said gold, 14, 15, 16, 17 gold laggard. So how did you decide saying I'm going to still stick to gold, right? International, very volatile, but consistent, but very volatile, right? So you still decided that you would go with international. Low and volatile means you're not making any return. It's risky, right? That's what you would understand when you go back, right? You look at corporate bond, you look at GSEC, you look at credit, very strong, very strong, which means that debt in that particular phase, that debt in that particular market did extremely well, right? Small cap not very consistent, right? Small cap again not very consistent, though volatile, but this is not. Uh, so small cap returns are not actual performances, right? Small cap returns are liquidity getting pumped into small caps, which means that people are willing to pay more and more for the same sort of business, for the same sort of asset class. They're just only the valuation is continuously going up, right? Because somebody else is willing to take it from you at a much more higher price, right? That's what is the small cap returns. Yeah, not fundamental return, but value more in terms of price return, right? Not valuation. Large cap. When somebody said large cap, it has been quite consistent in terms of performance. Right. So if you see from 14 all the way till 23, which is a good 10 years, right? When I was able to split 2, 3, 4 years for you, your answer continuously kept changing. Right. Second, there was nothing consistent. Only apart from large caps and gold, there was some bit of consistency that came in. But in one cycle of 14 all the way till 18, debt worked very well. Right. You had a good 3, 4 years in the debt market. That was a very big opportunity. Then you had some opportunity coming in on the gold side. Then within equity, you had some opportunity coming in both on the global side and on the domestic side, right? So yes, you need to have a mix of all, right? But how much should be the mix depends on what your goal is, depends on what your risk profile is. But this is not also the case where you should have all just for the sake of having all, right? In some cycles you should go overweight on the debt side, like 14 and 17, but in some cycles yeah, you can go more overweight on the equity side, right? So you need to understand that pessimism and optimism in market cycles work very similar to how it is on the asset class as well, right? Assets also have a different cycle. Debt has a different cycle. You see debt do extremely well, and now debt did not do extremely well. In terms of gold also in those years they had come off their own peak, but after that a lot of macro condition has changed globally. Naturally things are doing extremely well, right? But if you look at our perception of small and mid caps, they continue to be on the optimism side, right? They continue to be on the optimism side. We've just had 3 years or 4 years in the last 9-10 years, in which that's half, right? In which there have been deep corrections. So like I said, assuming you started investing in 2018, a lot of you said small caps, right? But first 2 years of small cap investments, your 100 rupees has gone down by 23%, which is somewhere at 77. So your 100 rupees has become 77. That 77% also is going down by 9. 77 rupees is also going down by another 7%. That is another 9%. So effectively, you're down by 30%, 35%, right? Somewhere that. So for you to make up that, it's going to take a lot, right? 100 becoming 70, 70 becoming 100 is very different. So our optimism continues to be there on the equity side, and within the equity side, our optimism continues to be there on small and mid caps. Right? This is what the entire exercise of asset allocation is. Yes, you have to be there in all asset classes, but each asset class will go through its different phase, and you need to be there at the right time. Right now, again, does your answer change? So does your answer change? So somebody said yes, but your answer has been a mix of all. So irrespective of the year, should we buy every time when an opportunity appears? That is at lower valuation. So I'll answer all these questions probably at the end of the presentation. I'm almost done with the presentation. Just a couple of more minutes, and then I can completely open to Q&A. Your answer does not change. Good, high, very high conviction. It's very good. Very good. I will stick to large caps only. This is very high conviction. Very good. You started off 20th going back also, you said, no, I'm going to stick to large cap. And your reasoning also was pretty simple. I will stick to large caps because I don't want more uh, uh, volatility. I want to stick to some bit of consistency that comes in. Yeah, perfect. So this is the entire asset allocation mix. Even if you start from 14, if you look back, gold did very well, and investors would have gone more towards the gold side. But 12, 13, 14, 15, gold did not do well. So you see there's a different winner every time. Right? There is a different winner in each particular cycle. If I take a 5-year cycle, if I take a 7-year cycle, if I take a 8-year cycle, if I take a 10-year cycle, if I take a 13-year cycle, right? Starting points do matter a lot. Where you start from also matters a lot. Right? Again, from 2010 all the way up until 2023, right? Your large caps have been extremely consistent. They've been extremely stable. Right? Everything else has been very, very volatile. Right? We have had 1-2 years of very good real estate return, and then from there on, you are seeing, a big dip when it comes to equity in real estate sector. Right? That's what it means. Right. So, what does this really mean? Right. When you're looking back, you're only going just because of this hindsight bias, you're only chasing performance. You're not actually going out and practicing asset allocation. Right. Now, if you look at what happens, this is what you actually went out and did. Most investors rely only on past performance to make investment decisions, right? But what I did was I started from a point to show you what has happened now, and what would you do, right? And you said no, because I know what's happened, I will go out and start only doing this. But where you start from, you're only going to look back, right? And this is where investors get trapped, right? Because we are so heavily inclined to look at what has happened, we don't want to look at what can happen, right? And you look at what I've highlighted, right? And this is all public data, right? So studies have shown that an investor's effort to outguess the market by jumping between asset classes results in underperformance, right? This is actually means you're just chasing performing asset classes. You're just chasing performance, right? You're not following any model in terms of market cycles, nor are you following any model in terms of asset allocation. And even if you are following something on the asset allocation side, again, there you're only chasing performance, and you're foregoing consistency in terms of compounding. At the same time, you're not investing at the right place, and you're not investing at the right time, right? And this is why that slide was very important, when you say that even studies have shown that a majority of the factors that go about in determining the portfolio returns, that is your return, is only going to come from asset allocation. It does not come from what you buy. It does not come from when you buy it, right? It's asset allocation, right? We are adding a one more layer, right? Because we are doing that exercise to see that because we are relying on past data, then we are trying to time, right? We only have to look forward. uh, but in all honesty, yes, we will all look at what has happened just to get a sense, just to get a direction of what can happen in the future, right? But all we are trying to tell you is, you flip the model, right? When there is fear, you be greedy. When there's when there is greed, you start becoming fearful. Now, that's how you're going to actually make the best use of asset allocation. So when do you make the most of all asset classes? Now, I know that things keep changing. So what are the things that I should actually look at to decide how much of what to put in a particular asset class? How do I make sure that asset allocation is actually working for me? Now, uh, this is again his public data, and uh, this is also data that comes to us. So if you look at this is ICICI's ICICI AMC's valuation index. So it's a good way for you to check temperature of the market, right? Uh, Now this takes PE, PB, market cap to GDP, everything into rate, everything into consideration, and only then this number sort of comes up. Now this was in November. This was before we hit an all-time high, and even at that point in time, it was very neutral. So what do you do in a very neutral strategy for equity? Right, you stretch out your decisions, right? You sort of delay it, right? Now, because we are in that part where we have gone from neutral to the next phase, which means you have to look at opportunities on the debt side, right? That doesn't mean going from one asset class to the other asset class, a lateral shift. No, your weight in one asset class needs to sort of reduce. You can either do that by having a lateral shift or adding more incremental money that comes in. Incremental money, which means that more money from your side has to go in from the debt side. It's not booking profit from one asset class and going to the other class, but it's incremental, which means the weight of one asset has to come down and the weight of the other asset has to go up. That can only come in when you start contributing further, that is more money into debt. Right. So this is one just very simple, right, example of how do you actually go out and start checking temperature. Now let's go one step further just to see in terms of valuation, what do we actually need to look at. Right now, again, this is public data. Here they compare equity and debt both together, right? So if you see on the right hand side, you are seeing that uh, uh, equity market valuations are not very attractive, which means you cannot allocate more, but it's not come to that place where you allocate less, right? And then again, if you look at the left side of uh, the chart, it's fair to it's just at fair valuation. It's not very expensive, it's not very cheap also, right? Which means that equity doesn't offer you that sort of pessimism, right? Equity is offering you optimism. That's how you should look at it, right? And we are not in that place where you go extremely overweight on equity, nor do you go underweight on equity, which means that incremental money has to go more towards other asset classes. Right? It has to go more towards the debt side. It has to go more towards the gold side. It has to go more towards other aspects. Right? I did not put international here for a conscious choice. I'll do a webinar particularly for international. I think that's happening next month. So when you do get that invite on social media, do register for it. But just in terms of pure domestic valuations, equity doesn't offer you that pessimism. It's still offering you optimism, and pessimism is being offered to you in all the other asset classes, right? This is what that chart is showing. So now I will open up the floor for Q&A, and uh, I'll start addressing the older questions also. But whatever questions you have in terms of asset allocation, whatever questions you have in terms of what you should do right now as an investor, that please put it in the chat box. So there was a question that came in saying, for a 52 age moderate risk profile, what should I do? Do I need to stick to 50% large cap, 15% small cap, 15% mid cap, 20% flexi cap? Is it good or need to change? Do I need to consider gold as debt or separate asset class? You have to consider gold as a separate asset class. Second, see, when you look at first, what is your goal? What are you saving for? Are you going to save for retirement? Then if you're going to save for retirement, 50% large cap, 20% flexi cap. So which means that your 70% of your entire portfolio is going to be a majority of, let's say, Nifty 100 or Nifty 150, right? You are going to be within that segment. And 30 odd percent is going to be in small and mid caps, right? But a majority of money still goes within the top 100, 150, right? One thing you should always consider is for what goal you're investing. If you're going to invest for retirement, then definitely you need to have a conservative approach in terms of valuation, which means that depending on your goal, certain asset class, so within so categories within a particular asset class do not work for you, right? So just purely in terms of valuations, uh, the risky parts of the market actually get negated off. So you have to uh, replace that with conservative asset classes, and within that conservative categories, purely in terms of valuations, purely in terms of fundamentals, right? But gold and debt you have to consider as a separate asset class. Gold is to be considered as an alternative currency, because right now the scenario for gold is you cannot compare gold to equity, nor can you compare gold to debt. They are all separate. Gold has to be compared to a currency because it is a currency. Debt naturally because it's fixed income, so you cannot compare it to a growth asset class like equity. But gold and debt need to be considered very separately. Okay, so there was one more question on irrespective of the year, should we buy every time when an opportunity appears? Yes. Yes, whenever there is low valuation, definitely you should look to participate, right? You should always look to participate, right? And you cannot participate everywhere, right? There are specific times in which your participation needs to be concentrated only on one particular asset class, right? So you have to capitalize only on that one particular asset class for a long period of time. That's why even in the chart it said incremental money, which means they are not leaving out equity. They are saying we don't, it's not that we cannot have equity in the portfolio, but further money that has to go in has to go into other asset classes, right? So yes, definitely you should participate uh, whenever the opportunity presents itself to you, and that would differ in each asset class, right? So right now there is an opportunity on the debt side and on the gold side, so incremental money definitely should go towards those areas. For debt allocation, can we choose arbitrage fund or short-term fund or money market? See, I am doing a purely debt presentation next month. But ideally, what I want to address even there is when does the opportunity arise in debt, and within debt, where does the opportunity arise? Right now, the opportunity is on the shorter term side, on the shorter term duration side. But it depends on what your goal is. It depends on what you need it for. Because I don't think that there is some uh, uh, particular template or particular formula for this. It all depends on what your goal is, right? So if you have a filter just purely in terms of returns, just purely in terms of high to low, then you are bound to make only decisions that you take uh, looking at the rear view mirror. It's all going to be on the past, right? So likewise, even for gold, it depends on whether you actually have a good amount of physical gold, whether there's some bit of SGB that's there for you, and only based on that will you be able to take a proper decision in terms of what is working out for you, what is going to work out for you in the future, because it all depends on that one particular goal of yours. Should we consider one multi-asset allocation fund or a mix of funds? This is a very good question. This is a very good question. Whether we need to choose, a multi-asset allocation product itself, so I don't need to do anything. See, you can choose that. Yes. What you need to have in mind is that when for a multi-asset fund, you compulsorily need to have some bit of percentage in particular asset classes, which means that I cannot go less than 50% or I cannot go less than 60% in equity. I need to have that much asset. I need to have that much of uh, contribution that is towards equity, that is towards debt, that is towards gold. But there are some cycles in which you don't need that particular asset class, right? So the fund would be forced to buy it because their mandate is like that, right? I would say that, like for example, on the debt side, it might not make sense for you to have, longer term or medium term. where you can take that call. No, if it makes sense for me to do short term, I'd rather stick to short term, right? So you can take care of that asset allocation. How do you take care of that asset allocation? It depends on your goals. So I think you can sort of get in touch with us. We will be able to help you out to help you understand what you can do in terms of asset allocation. But when it just comes to asset allocation funds, they have this sort of a cap that they cannot do. They cannot go beyond a particular amount of percentage in one asset class. On the flip, also, when things are going bad in that particular asset class, they compulsorily have to be there. They cannot go to zero, right? So if that is okay for you in terms of that mandate, then you can stick to it. If it does not work, then we can help you out in terms of understanding how asset allocation works for you the best, right? Which means that we don't have a particular cap. We can go 100% in equity, you can go 100% in debt also, we can go 100% in gold also. So that's not going to be a problem. uh, when it comes to international, why I don't choose Japan is my portfolio. Is it advisable? I read Japanese market will be reaching new highs in the coming days. Again, you're doing hindsight. So, uh, interesting thing about Japan is for 20 years they never made any money. So that was the Japanification of financial markets. But that's what they say. But for 20 years they never made any money. That the optimism was so high that earnings growth never came in. Right? So we also have this. I thought Market Wrap Journal, in which we have put all our learnings over the last uh, 10 years, and it's free. You can just go to maybe at the end of the Q&A session, I'll probably be able to copy paste that. But uh, I think there's one proper rap that said that uh, how do you make that compromise, because you know that in a optimistic market, how do you make a decision to choose a particular idea, and that only boils down to earnings growth of the company. So if the earnings growth of the company is very high, naturally you will be rewarded. If it's low, then you won't be rewarded, right? But what happens during the point where there is a lot of optimism, then you're overpaying for that earnings growth, right? And what happens in the subsequent years is that you don't make incremental money, because what gets spread out for the next 5-7 years comes to you in 1 year. So you don't make any money. Hmm. So for 20 years or something like that, Japanese stock markets didn't make any money. And right now, because inflation levels there are going high, a lot of investor interest is coming in. They are seeing inflation after a very long period of time. So naturally, it is reflecting on the margins also. And the Japanese stock market index does want to rejig its entire index in terms of its fundamentals. So again, if you choose to do this, you're only going to go with past data, but your past data shows that you've not sort of investors who made that decision did not make the right decision. Right now, it's just a knee-jerk reaction, because money has been coming out of Chinese market, and money has been coming in here. Money has been coming into all other wherever there is growth that's being offered. Money is just chasing growth. So right now, on the global side, you should be very cautious. You should not chase anything on the global side right now. So how much percentage allocation can we keep in gold? See, it depends. See, right now, you can have a good balance of 10 to 15% on the gold side. Again, that depends on your particular risk profile, depends on your particular goal. What is it that you're actually trying to do? When you say, I want to invest on the debt side also, I want to invest on the gold side also, I want to invest on the equity side also, right? That's why for a multi-asset sort of an allocation, you need to know what your goal is, right? If your goal is I want to I want consistency in terms of returns, then your allocation towards each of these asset classes needs to be very dynamic, right? That's why the fund won't do that for you. We will be able to do that for you, right? Because your allocation towards these asset classes needs to be dynamic in each cycle, right? And that sort of direction and that sort of clarity you will only get if you have a particular goal. Like for example, if your goal is that no, I want to fund whatever retirement comes, so it gives us very limited years in which we can take risk. After it all has to go to stable fixed income sort of instruments that fund for whatever expenses you are having uh, before your retirement, right? So all of that calculation needs to take into place. Only then you will be able to take an informed decision. Otherwise, you're just going to go all over the place. Otherwise, it doesn't make sense, right? So for a small investor of 10 to 12,000 per month, how can one decide percentage allocation between funds, or is it futile to diversify with small sums? It's not futile. Right now, see, like I said, even on the equity side, nothing is very juicy, nothing is very bad at the same time. Right? So you can commit to some money on the equity side, right? Then you can choose, within that, within debt or within gold. Right now, the opportunity is more present on the gold side. So you can have a mix of two first, and then whenever the opportunity comes in, you can put incremental money. Like I said, increment, right? Not shifting from that one, but not stopping your SIP. Never stopping your SIP. Never stopping your SIP. Right? But incrementally, you can add more towards the other asset class. That means it motivates you to start saving more. It will motivate you to get your budgets properly in check, where you can take that call of committing more money when an opportunity arises. So always have your sort of budget very, very strict. You can't be too strict with yourself. Naturally, you have, there are entertainment expenses, there are other expenses. Obviously, we won't have a goal to travel. So whenever you can, incrementally you can add on to the other opportunities. Like I said, right now, wherever there's opportunity, you stick to that. Right now there is opportunity on two asset classes, majorly on two asset classes, that is debt uh, and gold. But uh, this is not the time where you have to completely stay from equity also, right? So we can stick to two. Right now we can stick to two, and then maybe you can add as and when, uh, uh, whether opportunity deepens or gets much better, then you can take that call. But right now you can just start off with one or say two asset classes, just to start saving money. Opportunities will keep coming to you. Don't think that you're going to miss out any opportunities. Opportunities will definitely keep coming. So within equity, what we are doing here is we are also on the conservative side. So we are going more towards, so all on Milestones to Wealth, our entire endeavor is to make sure that we enable investors to save more. We enable investors to save regularly, and we are able to do that by just being conservative, right? Our entire model is built on that. Yes, conservative investors have a much more better journey, compound at high rates consistently, right? So that's what we are doing at Milestones to Wealth. So we will be able to take advantage of each asset class also, and within that each particular asset class, wherever there is conservatism, wherever there is good valuations available, we will be able to save there, right? So right now you can just start off with one or two asset classes, and then slowly you will get more opportunities. There's a comment. I realized that if I couldn't pick individual stocks and stick to them in highs and lows, I would rather stick to mutual funds and focus on it. Perfect. What was stopping me from doing this earlier was that the returns on mutual funds didn't feel like a personal achievement compared to picking out individual stocks. But yes, at the end of the day, returns and stability matter. So fantastic comment. I think this is a very, very good. I mean, you're very, very aware. It's very good. You're accepting, you're being honest. I really appreciate you, sir. Thank you so much for actually, sticking to the facts, sticking to honesty. Uh, but one thing I would say is that yes, mutual funds are not like individual stock. They are a basket. And yes, there is a good thrill that comes to you when it comes to stock investments, which you sort of might not have time always for you to get a good kick out of. but mutual funds at the end of the day offer you that stability, and that's what that matters. So if you're able to compound at high rates, for years together, then naturally, you would be able to save a lot more. Naturally, all your goals will be met. But thank you, sir, for your honesty. This is it's a very, very good comment. Right. So I don't think there are any further questions. If there are any questions, I'll just keep the chat box open for another minute or so. Okay. I don't think that there are any further questions. Thank you. Thank you, everybody, for joining in on a Saturday morning. It's a good long weekend also. So have a great weekend ahead. And do get in touch with us. I've put the number, I've put the email. So whatever questions you have, whatever service that is required from our side, definitely we will be able to assist you. And thank you so much. Thank you. Sorry about the journal. Can you just send a hi on this WhatsApp number, and we will be able to share the journal to you.